As a property investor, it's crucial to understand the dynamics of the property cycle and how they can significantly impact property prices, rental yields, and overall investment returns. Now, in today's show, I'm going to have a chat with Brett Warren, National Director of Metropole, and we're going to discuss a bit about these factors and also what makes an investment-grade property and location. If you think about it, you've probably heard me talk about investment-grade a bit if you're a regular listener to this podcast, but what am I on about? Well, at the end of today's show, you should have a good understanding of the various factors that drive property cycles so you can take advantage of the market in 2024. Now, regular listeners to my podcast would know we usually produce 2 shows a week, but during January I'm going to be offering you 3 shows a week, a combination of some new shows to keep you updated with what's happening in our markets, and also we're going to be replaying some of our previously published shows, and that's what's happening today. If you're like many listeners, you've probably not heard all the back episodes, especially all the very many new listeners, and by the way, thank you for all the great new subscribers that we're getting. Boy, has it been a fantastic year for our podcast last year. We've now reached well over 5 million downloads. That's a milestone I'm really proud of. But if you're a new subscriber, you probably listened to a few shows going backwards, but maybe not as many as you'd like. So I'm including this, plus a few extras over this month to give you some fundamental shows. By the way, you may even have time to go back to more back episodes as well. If you're a new subscriber and you haven't actually, a new listener and haven't actually subscribed, and you get some benefit from this, hey, stop for a second and subscribe as well. Anyway, on with today's show, where we talk about what makes an investment-grade location with Brett Warren.
Welcome to the Michael Yardney Podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Location. I'm sure you've heard the importance of location. In fact, you've probably heard me say that location of your property will probably do about 80% of the heavy lifting of its capital growth. During the recent property boom, almost every property is sold, but now we're seeing a flight to quality across all markets as there's less competition, higher borrowing costs, fears of falling property prices continuing. That's made buyers more cautious. That means today, it's more important than ever for property investors to focus on investment-grade locations. But what makes a great location? What makes an investment-grade location? That's the topic I'd like to discuss today with Brett Warren, National Director of Metropole Property Strategists. Hi, Brett.
Yeah, Michael, good to be with you. And look, obviously there's many factors that kind of make up an investment-grade location. And Michael, I've often heard you say it's actually quite simple, but it's not easy. And I think that's the main thing, particularly given that everyone and everything's kind of worked in the last couple of years. So I guess some of the things we look at are really, really important and probably contrast to other things. We look at long-term fundamentals rather than short-term factors, which I know a lot of investors make because they're trying to make a decision about the next property and they're looking for the next information and data set to kind of clarify their decisions. But I guess it's the longer-term factors we look at, isn't it, Michael?
I think that's very important to say because there's a whole generation of investors who've got into the market over the last couple of years and they think they made good decisions because, as you said, almost every location worked. Outer suburbs, inner suburbs, regional Australia, lower socioeconomic, higher growth areas. Over the last year, as property values fell, the markets have been more fragmented. Apartments have performed differently to houses. Inner suburbs have performed differently to outer suburbs. So you're right. What we're wanting to look at is what's going to make an investment grade location over the long term, because the property that you're buying now almost certainly isn't going to be there to give you the support this year and next year, but maybe in 15, 20 years' time when you get out of the rat race. And we also wanted to make it the sort of property that's going to be the stepping stone for the one after and the one after. So I know that you and the team at Metropole dig in a lot of research. So let's discuss the various aspects. And what's the big one that you think makes a difference to getting a great location?
Yeah, the big one for me, number one, we've got is demographics. So a fancy word, but if we break that down slightly, the demographics we're looking for predominantly areas where there's owner occupiers, more owner occupiers than investors. Owner occupiers make longer term decisions. If there's a recession tomorrow, they'll eat Maggi noodles to hold on to their home. They're very stable. They don't fluctuate like investor suburbs. And I guess a certain kind of owner occupier, Michael. And for that, we're looking for, I guess, areas and residents that incomes are growing faster than the state average and faster than inflation. Look, it's not a judge of person, as we say. It's, looking for the more affluent type of people who have high savings rates and buffers. They can pay more for property. In a downturn, they've got the ability to ride it out. And, the rents are also going to grow faster. I know a lot of people look for cash flow positive and properties and that, but if you're looking at an area where rents aren't growing, it's not going to stay cash flow positive forever. So that's probably the number one thing we look at, looking for the owner occupiers with higher demographics in the right kind of location.
Well, I know our research department has got every suburb in Australia and all the statistics going back almost, for 45 years, as long as the statistics have been produced by the Australian Bureau of Statistics, looking at wages growth, owner-occupier percentages, supply and demand. And so you're right, we're looking for demographics where wages in general are outperforming average growth. And in general, in the state, and in general, that's suburbs that are gentrifying. Moving forward, I think as our markets are more fragmented, blue-collar areas, lower socioeconomic areas, and as you said, this is not a judge of people, they're going to suffer more with the ravages of inflation, while those with more steady, stable incomes, they're going to give more stable property markets. If you look at the demographics in many of the inner and middle ring suburbs of our capital cities, many people have bought their properties 30, 40 years ago and have no mortgage. There are people who bought their properties 10, 15 years ago and paid off half their mortgage. And there are some people who've bought more recently. If you go to the outer suburbs and the new home areas, the demographics are all much the same. You're actually mainly young first home buyers, and there's investors buying out there those house and land packages, and they're the ones who are going to suffer more as interest rates are creeping up, as inflation is biting away at people's budgets. And they're the areas that are less likely to grow in the future. And if you think about it, your future income is going to be dependent upon your tenant's ability to keep paying rent and higher rents over time. So that's, again, the importance of looking for the right demographics. So that's a really good starting point as we're discussing what makes an investment grade location. What's the next factor you look at, Brett?
Well, the next factor I think is not just related to property. I think it's related to almost anything. Supply and demand. It's critical. We've got to get that ratio right. And what we're looking for is actually an imbalance. We want an area where there's low or no supply, but there's huge demand. So, think of the inner to middle ring suburbs. It's very, very different to the outer suburbs where you can probably build stage 2, stage 5, stage 7 and keep building, estates and houses and things like that. There's a lot of supply in those kinds of areas where, as we kind of mentioned, we like to invest in that inner to middle ring suburbs where there's more demand, and you can't just knock over and build 1,000 houses. And obviously we want to steer clear of those areas that are oversupplied with apartments and things like that as well. So it's very different, the inner city, inner to middle ring, to the outer areas. And that's what we have to look for, that imbalance.
Sure. So in houses and townhouses, it's actually hard to find enough land in those suburbs to feed demand. On the other hand, we do know over the last decade, there's been an oversupply of apartments in most of our capital cities, and that's subdued the growth of established apartments, subdued the rent and their capital growth. But moving forward, the cost of building new developments is so expensive now, and that's a factor from the side effects of COVID, lack of supply of goods and materials and lack of labour. And so therefore, all the new apartments, when they eventually come out of the ground, are going to have to cost considerably more. The suggestion is up to 30-40% more than current apartments, and that's not financially viable at the moment. So I also see that fundamentals of supply and demand are going to push up established apartments or family-friendly apartments, not the little boxes that were built a couple of years ago, Brett, because people with affordability are now having difficulty buying houses but still want to live in the same neighbourhoods. So supply and demand's a big one. As we go through the factors that make an investment grade location, what else do you consider?
Yeah, obviously, probably related to demand, Michael, is the employment opportunities. And I think I've said many times, Brisbane's probably struggled with that over the last decades, but we're one of the great places to live, but no one can live here if there's no jobs. And we're finally starting to come up with some jobs and create those kinds of jobs. So for me, employment opportunities are really, really important. It's not just a new hospital or a university that might employ 400 or 500 people, but it's the massive CBDs and infrastructure. It's the huge airports and second runways and second airports and things like that. And it's also the hospitals. Our inner city hospitals are no longer just hospitals. I know there's 3 or 4 hospitals in each kind of capital where maybe one of them specialises in mental health, or there's a facility there for aged care or something as well. And so there's a huge kind of, I guess, spin-off from these kinds of hospitals. And then, there's also those other bigger facilities as well, which are only happening in the CBD and close to the CBD and don't happen as much in the outer areas.
Sure. So there are jobs and there are jobs. And again, it's not a judge of people, but Australia, as it's becoming a knowledge-based society, people in the higher skill levels get paid a lot more. And we know that the Australian Bureau of Statistics break down jobs by different skill levels, and that has a lot to do with your education as well. But skill level 1 and 2 jobs, their wages are going up considerably, where we know in general wages growth has been a bit subdued. But this again gets to the fact of some people moving forward are going to be able to afford to pay and prepared to pay to live in certain areas. And similarly, tenants are going to be prepared to pay to live in those areas. And so that's, I think, one of the other big things that's changed in Brisbane, as you said. While the high-paying jobs used to be in Melbourne and Sydney, and they still are, and many graduates left Brisbane to go to the big smoke, a lot of the higher-paying jobs are moving to Brisbane as well, aren't they?
Yeah, and that's well overdue. And that also relates to Brisbane itself and Queensland itself, because people are moving to Brisbane for those kinds of roles. We're getting more international students as things start to open up as well, and that, as you know, progresses through. So, interesting times, that's for sure.
Sure. Well, in Melbourne, for example, I think we're the science and the health capital of Australia, where there's a large knowledge base built around the universities and CSL, our big international Commonwealth Serum laboratories, but they do a lot more than serum nowadays. That's where it started, or the biotech. So that's the sort of areas which are going to attract a demographic that's going to be able to afford to and keep affording to pay for properties and push up the value of the properties. So employment opportunities around the suburb, not necessarily in that suburb, but I guess part of the thing is nowadays we're wanting to not have to travel too far, and it's going to get harder and harder to travel. Now, infrastructure and amenities is another big factor, isn't it?
Well, that's right. And I think when people are moving to a certain location, they obviously want to live as close to their employment as possible. So it might be a hospital or it might be a CBD or something. So the next thing is actually working out how they're going to get there. And obviously, the more public transport options, the more infrastructure to get to there, and the simplicity to get is going to be much, much more in demand than if you're having to travel 40 or 50 minutes and you're stuck in traffic every day. That's getting less and less. People are less patient. So, that's important. And then when you are looking at your place to live, you also want those kinds of amenities we spoke about, coffee shops, restaurants. Michael, I've often heard you talk about a third place that we kind of missed during COVID. So, maybe parks or gyms or places to worship and things like that as well become very, very important. And it's not good just to have one coffee shop, is it, Michael? We've got to have a choice. We've got to be spoilt for choice.
Yes, we are. So that's the concept of the 20-minute neighbourhood, where people want to live 20 minutes drive, walk, bike, from a variety of things, as you suggested. And since the pandemic, home is no longer just simply the place where we rest and enjoy some downtime. It's often the place where a lot of us are working now. So I think neighbourhood is more important than ever. And we've found that buyers are willing to pay a premium for properties within a short walk or a short distance of great shopping strips, as you said, the favourite coffee shop amenities, beach and water is very important in many of our states as well. And these are the type of neighbourhoods where investors, home buyers are flocking to, and investors should consider, because this is what makes a investment grade location. I guess the other facilities that are important to schools, Brett, aren't they?
They certainly are. And, we obviously see that in Brisbane with, one side of the road could be $50,000 more or less just because of the school catchment. Schools are very, very important. I think if you just follow, I guess, an owner-occupiers mentality, Michael, if they're moving here, they're certainly going to move here for a job. If they've got kids, then it's very important they get their kids into a good school, and then it's lifestyle and location. So you can definitely add school catchments to that list as well.
Sure. Okay, so as we go through what makes a great neighbourhood, I guess in line with what we just said a moment ago, walkability, there's a website called walkscore.com which measures every suburb and how walkable it is. Now, different people expect different things in walkability, but in investment grade locations, as we say, do have that easy access to amenities. And I do remember reading a report a while ago showing that those areas that are more walkable had more demand, understandably, and had more significant capital growth over the long term. Now, this was before the boom where everything grew. And so that messed up some of the long-term statistics. And that's why we've really got to go back to the fundamentals of see what's worked over the long term. And more walkable areas had 36% more growth over a 5-year period. Again, it's that concept of the 20-minute neighbourhood. I think another really important factor, and we touched on it a moment ago with the demographics, is gentrification. So and moving forward, as the general market's not going to grow as much. Now, we keep mentioning that this is the year of the property market reset. The market's going to bottom in due course when interest rates peak, when inflation peaks. But we're not going to have a boom again. We're going to go into the stabilisation phase of the property cycle where buyers start to come into the market, vendors start putting their properties on the market again, so prices aren't going to keep rising as much. Eventually prices will. But if we find areas where they're gentrifying, where more affluent people are moving in and doing up their homes and improving their homes, that's going to make a big difference to the values in the area, isn't it, Brett?
Yeah, definitely. And look, you can see that on a number of levels. Obviously, firstly, you can see those old tired warehouses, that their land's just become too valuable. They're not, I guess, maximising what's on the site. So they're being transformed, and the old rundown streets and neighbourhood centres are just getting a new lease of life. And I know certainly where I am, we're getting new cafes popping up, and microbreweries are the order of the day, and hairdressers and boutique butchers and bakeries and things like that as well. So you start to see that older demographic and maybe the low socio demographic move out of the area, and the young families and busy young professionals are moving in that demand that type of thing and are prepared to pay for it, as you said. And I guess the other thing is breaking it down to a street level too. And I can give you an example. We had a great property we were looking at this week for a client we're assessing, and the first thing the buyer's agent said to me was, you should see the properties around this particular property. So I think gentrification is a really important tool because, if houses are being knocked down and renovated and rebuilt around you, and you've just got the old tired property sitting there on a really valuable block of land, it's the land that's appreciating in value and becoming more valuable. And Michael, you haven't even lifted a finger, have you?
Interesting. Now, you know that a year and a bit ago, your team in Brisbane bought a property for Pam and me that we're now doing a 2-townhouse development on, or a 2-home development. In fact, that's what we do for a lot of our clients. So we are doing the manufacturing of capital growth like we mentioned a moment ago. But I bought the property sight unseen because I trusted you and your team. When we eventually went down the street and had a look, every third house is the old Queenslander that's gone, and now there is new dwellings there, and that's pulled up the area considerably, hasn't it?
Yeah, well, it's probably lucky you didn't actually see the property site seen, Michael, because it was a pretty ordinary property.
It was, wasn't it? Interestingly, at the end of the street, but far enough away, there's a great private school. You just drive or walk a couple of minutes around the corner and there are shops. So I guess what I'm saying is this was something that your team, our team, bought for me, but it's what we do for clients all the time as well. So while we're helping listeners of this podcast understand what's going on, we also want to make it clear that these are the fundamentals that we use for ourselves, you and me personally, and also to help our clients outperform the averages. And I've mentioned it a few times, Brett, that a survey of a couple of years ago of the results of our clients showed that they're 7.3 times more likely to own 6 or more properties than the average property investor. In other words, there's less than 1% of investors who ever end up owning 6 or more properties. But when you get advice, it should help you make better decisions. And if you don't make the right decisions, you're going to end up like 90% of investors with 1 or 2 properties, or that large group that don't even ever keep their properties. But our team at Metropole use the research that we're talking about. So we're talking big picture, but there's the detail of which of the suburbs, and then we've got to have the on-the-ground knowledge, isn't it right, Brett? Because it's a combination of the data plus the perspective. So it's the art and the science, because even one side of the street or one end of the street compared to another makes a big, big difference.
Yeah, it does. And I don't understand how people can fly in, fly out and try and get an idea of that. We see that they're making those kind of rookie errors all the time. And, our team have been in those markets for, 10 years or more. So they understand the good side, the bad side, and where to buy, what not to buy. And it makes a huge difference. So don't just assume you can buy in a particular suburb, because in many cases, most of the suburbs, we only buy in probably 30 or 40% of those suburbs. We're looking for that right location.
Sure. So if you're interested in getting set for this property cycle before it resets, before everyone else knows about it, I'm not suggesting you get in right now because I don't know your circumstances, but I am suggesting you have a chat with our team at Metropole and Brett Warren. Just go to metropole.com.au, explore your options, have a complimentary clarity consultation, giving you clarity about what your options are. Now, Brett, as we're going through this list, we talked about locations, but one of the other things I think is important, we are human, we are emotional. The neighbourhood character makes a difference. In those outer suburbs, they all look much the same, but in each of our capital cities, they've all got different styles of property. Adelaide's got a very different style of property to Brisbane. Brisbane's got a different style of property to Melbourne. So you've got to find out what's appropriate, but you're also looking for a neighbourhood that's got neighbourhood character. Sometimes it's related to gentrification, but sometimes it's just the old historic buildings that are there.
Yeah, look, it is. It's obviously those superficial things, but I think each neighbourhood also has a personality, doesn't it? And probably each pocket within that. So it's really understanding what the area demands and what's working well in the area. And you don't want to go and build a different type of property or something. And if there's 4 or 5 different types of properties in a street, it doesn't really blend well together. So you see a lot of the better streets and the superior locations have very, very similar type of properties. And you've got to understand that. Again, another push for the knowing what's going on at ground level to make sure you get that right.
Sure. And in today's, let's call them interesting times, I think we've also got to look at safety and security, Brett.
Yeah, look, a low crime rate is something we obviously target. We're looking for areas with the low crime rate. And even there's some great little demographic websites that show you different crime rates within different pockets of different areas as well. And that's quite interesting because you assume that, the whole suburb's going to be the same, but maybe it's not. And that's a really good tool that we use. You want to get into those areas where people are comfortable with their families and their kids are safe, and those kind of areas are in high demand as well, and that'll help support property prices.
Well, people are prepared to pay more to live in safe locations, aren't they?
Certainly, yep.
So let's summarise it slightly differently. There are different types of locations. As they say in the ads, there is more to consider. Not all real estate's equal. So I believe, it's a bit like the Monopoly board there. Remember, everyone knows the top ones, Mayfair and Park Lane. Everyone wants to get into there, and no one really wants to be in, what are the purple ones, Old Kent Road.
Old Kent Road, yeah.
Sure. So let's break it down. I think, first of all, there are what I'd call discretionary locations. These are the most expensive locations in our capital cities. This is where, as we said a moment ago, the established money locations where most of the residents have lived for a long time. That means that many residents have paid off their home a long time ago. In general, these are the established inner ring suburbs of our capital cities. In the middle ring, think of, Brighton, Kew, Toorak in Victoria, Tenerife and New Farm in Brisbane, Darling Point, Bellevue Hill in Sydney. There's lots of suburbs like this. But over the long term, this sector of the housing market has outperformed the other sectors. That's mainly because of its scarcity. But in particular, we know the rich are getting richer in Australia. The average Australian can't afford to live in these areas, but the rich are prepared to pay a premium. These A-grade locations, though, Brett, they tend to fluctuate more. In booms, they do really well because people are prepared to pay a premium. And during the last year or two, they've suffered a little bit more, but that's just the cycle of those suburbs.
Yeah, well, I think you say it quite well when sometimes a $10 million mansion will do the same as a $12 million mansion. So you kind of, you don't want to buy at that top end. You want some more, I guess, some a level of diversity in that market and a good pillars, more pillars to that economy and a bit of a fatter section of market depth as well, rather than just, single higher end property. So you're right, it does fluctuate.
Sure. So while there are these, well, let's call them discretionary locations, because you don't have to live there, but if you've got the money, you've got the discretion to do it. While they're good, we don't consider them investment grade because of the volatility. Now, that doesn't mean you don't live in those suburbs. Then there's what I'd call the aspirational locations. And these are the upper middle class suburbs and the gentrifying suburbs. Gee, gentrification keeps coming up a lot, doesn't it? That we consider A-grade suburbs. There's suburbs like Bentley and Elwood in Melbourne, Paddington, Mosman, Randwick, Newtown in Sydney, Camp Hill, Grange in Brisbane. There's lots more than that. All I'm doing is giving some examples because these are where the affluent, and in general now it's more millennials, are aspiring to move as they enter the family formation stage. And this is, again, goes back to the demographics that you were talking about, Brett.
It does, and those demographics, like you said, they're willing to and able to purchase good properties at good prices, but they're also then willing to come back and put their own touches on it. And that's where we're kind of seeing the gentrification. And as I alluded to before, there's much more market depth. It's a fatter market there, and you're getting much better results. There's less volatility, and they do make very, very good investments because people tend to get a little bit emotional and can pay too much, which is kind of what we like to see. Particularly, like we said before, if you've got the one parked around the corner, just kind of sitting there.
Well, that fits in also with what you were mentioning earlier on. If you go down these streets in these neighbourhoods, you'll see new developments occurring. You'll see infrastructure, improving facilities, improving services. And this creates a ripple effect that produces economic, social and cultural change in these suburbs. Just like you said, in your own suburb, the shops are changing. The nature of the shops are changing. The coffee shop, hey, you got them in Brisbane now. I remember when I first used to go to Brisbane 30 years ago, it was really hard to find a place that was even open on a Sunday, Brett.
Yeah, look, it's certainly changed. Particularly, I think as some of those bigger, I guess unit complexes and stuff go up, they just seem to have a coffee shop under every one. So it's quite interesting how they all compete now, and it's really raised the coffee standard. And also, we're seeing the same with breweries. I think Brisbane's becoming a bit of a micro brewery capital, especially with the warmer weather and stuff. So it's quite interesting.
Right. Now, we're talking about the different types of locations. So we mentioned the higher-end discretionary locations, the aspirational locations, which is where we like to invest in. And then there are the more affordable locations. This is where most homeowners and many investors look because that's where they can afford to buy. However, sometimes investors buy in these locations because they're, well, let's just use the word advised to buy there at the cheaper end of the market. There's no doubt that some affordable areas make good locations, especially those that benefit from the ripple effect from adjoining aspirational locations. So eventually, some of those affordable locations do become aspirational themselves. On the other hand, though, most locations at the affordable end of the property market underperform in the long term with regard to capital growth and with regard to rental growth because many of the owners there, as we said a moment ago, they're young families. They've stretched themselves at the moment. They've stretched themselves to their financial limits to get into the market, and good on them because down the track, 20, 30 years down the track, they're going to be so happy they've made those decisions. But at the moment, though, it's going to stifle, it's going to hamper ongoing capital growth. Unfortunately, with what's happening at the moment, many of them are 1 or 2 weeks away from broke, as are many of the tenants in those locations. So therefore, they can't afford to keep paying higher rents. So I personally, as an investor and as clients of Metropole, we recommend steering clear of affordable locations because most won't ever gentrify in your lifetime, which means they're going to underperform with regards to capital growth and rental growth. Often owning properties in these locations, Brett, are more trouble than they're worth.
Yeah, look, I think you've made a couple of good points there, particularly with gentrification. There's a very lack of gentrification. People have maxed out. They can't afford to upgrade and renovate and modernise their homes. Also, incomes are quite low there. They're probably borderline with inflation, so they're not going to grow fast enough to improve. And I think particularly at this time of the cycle, Michael, I think a lot of our incomes and salaries are kind of maxed out with payments, particularly with living costs. So it's probably going to be another 5 or 7 years before that kind of market actually starts to turn over again. So, I think the other important point you mentioned there was that the runway, your investment runway, yeah, sure, 20 years' time it may start to gentrify, but there's probably better opportunities in superior locations that will get you further ahead. And that's probably why we can get our clients up to that higher level of owning more properties, because we're choosing the right locations which are growing faster and more consistently in the short term.
Now, I know some people are thinking, hey, I can't afford to buy into those better locations, but it depends which capital city you're talking about, and I'd rather own a family-friendly apartment or a townhouse in a good location than a house and land in a poorer location. So with affordability becoming an issue, and with the cost of new construction going up so much, as we said earlier on, townhouses in particular are going to be the preferred style of accommodation for more and more people moving forward, and so will the right sort of apartment. So there's one other type of location that I guess I'd call last choice locations. In every city there are suburbs where people live because they've got no choice. No one wakes up in the morning wanting to live in these suburbs, but social circumstances force them to. And of course, investors should steer clear of these locations as well. So just like owning the right locations on the monopoly board, owning the right investment property in that location is going to make a difference as well. But Brett, we've spoken about that in many other podcasts, so we're not going to today talk about what makes an investment grade property, but I think it is important just to recognise that you want an A-grade property or an investment-grade property, and again, choosing the right location is the first thing.
Yep, the first thing you said, Michael, location, 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 and as you said, it does 80% of the heavy lifting. So we've got to get that location right. You suggested that maybe you've got this in your portfolio for the next 10 or 20 years, but if you get it right and you pass it down to your children, it could actually be in your portfolio for the next 40 or 50 years. So we've got to get that right. We can't change it, and that's critical. So hopefully we've helped the listeners understand that today.
Now, I made a mistake a moment ago, and I'm even going to admit it, because I said getting the location right's the first thing. But in fact, that's probably wrong. You've actually got to plan first. The reason I say that is because a lot of people go out and buy a property close to where they live or close to where they want to retire or where they holiday, and that's not strategic. Buying a property is not a plan. The property you eventually buy should be the physical manifestation of a whole lot of decisions you've made, and you've made in the right order to make sure that you outperform the averages. And that's the reason why we believe, Brett, that people need to put a strategic plan together. And that's what we specialize in at Metropole. So if you're an investor looking for a time-tested investment strategy, and if you're an established investor, maybe you're stuck, maybe you're just wanting a second objective opinion on how your portfolio is going, I suggest you allow Brett's team at Metropole to build you a personalised, a customised strategic plan. Now, how detailed the plan needs to be, Brett, it really depends upon people's personal circumstances. There isn't a one-size-fits-all, is there?
No, there's not. And I think I like to use the analogy of going on a holiday, Michael. If you're going on a holiday, you know where you're flying to, what hotel you're staying at, what airline you're flying. You don't just rock up to the airport and hope there's a plane going to Hawaii. So I think understanding the destination is critical, because probably just like you would today, Michael, if you were driving into Melbourne, you'd speak to Google Maps and ask them to put you a path forward, and there'd probably be 3 or 4 different ways to get there. So it's no different to what we do from a property sense. Work out what the destination is, come back and understand where you are now, and then put 3 or 4 roadmaps together to kind of help you get there.
That's a really good point, because there could be a quick route. Maybe there's a slow journey. You want to actually go the long way and stop off along the way to holiday on your Google Maps, but maybe in your case you're going to stop off and have a baby, or life circumstances are going to change, or jobs going to change. So therefore there isn't one way of doing things. But when you have a plan, it'll help you define your goals. It'll show you whether it's actually realistic, especially for your timelines. It'll make sure that you're progressing along the way. And I think the other big thing is it's actually going to identify risks that you haven't thought of. And I think people don't understand the depth of the plans we put together, your team puts together, Brett. There's an asset accumulation strategy. There's a manufacturing capital growth strategy. It's partly a rental growth strategy. We also look at an asset protection and tax minimisation strategy, a finance strategy, including long-term debt reduction, and then eventually living off your portfolio strategy. So our plans are very detailed, and that's the right way to start, because it's going to mean that you're much more likely to fall into that 1% of investors who outperform the averages, as we said, as our clients at Metropole do. So if you want to find out more about how to do this, I'll leave a link in the show notes, or just go to metropole.com.au, leave us your details, and we'd love to be part of your wealth creation journey. And Brett, I know that you've taken on even more duties at the moment, but you're still keen to see people, aren't you?
Yeah, absolutely. Certainly helping them understand what we need to do to actually get to that point is been really rewarding, and I think it's giving people a lot of certainty, a lot of clarity to move forward in probably uncertain times.
Fantastic. Well, thank you very much. Now we know what makes an investment grade location. Look forward to catching up on a podcast again real soon. But of course, we speak 3 or 4 times a day anyway, don't we?
Yeah, absolutely. Thanks, Michael. It's good to chat again.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to talk to you about some things that are more important than just money. I talk a lot about money and property in these podcasts, but when you get to know me, you're going to realize that I believe true wealth is what you're left with after they take away all your money. Sure, money is important in some aspects of your life. It's important in those areas where it's important, and it's not at all important in other areas of your life where it's not important, is it? So, while we talk a lot about money, and I believe any problem that money can solve isn't really a problem, so we need money, I'd also like to just throw a couple of other thoughts out there today, just to help you realize that there are other things that you've got to concentrate on as well. A list of things that you're going to regret in the future if you don't know now. So I just want to re-emphasize some of these points that you're probably aware of. The first one is put your health and wellness above everything else. There's an old saying, if you don't have your health, you've got nothing. And this is very true, isn't it? The second thought I'd like to share with you today is take the time to do the things you love. Now, it may sound like a cliche, but maybe it's time to play more and work less. You're never going to regret taking a vacation. You're never going to regret engaging into a new hobby or spending a day with those who make you happy. In part of my busy calendar, every week I've got time set aside to spend with my children, my grandchildren. Pam and I, despite being married for many years, still have fixed time set aside to spend time just with ourselves, and we therefore appreciate each other better. So, despite money being important, I'm trying to share with you some ways of you enjoying your life. And another way is stop taking life so seriously. Why are you taking life so seriously anyway? Another thought is say what you need to say when it's there. If you love somebody, tell them. If somebody hurts you, tell them, let them know. If you're having trouble expressing your feelings, if you don't think you can tell them, write them a letter. Make sure those around you know each and every day how you feel. Another thought I'd like to share with you today is open your mind to possibilities. Don't be a pessimist. Don't be closed-minded. Optimists just do so much better in life. A further thought is follow your own path. Live a life that's true to you. It's too easy today with social media to compare yourself to others. Don't compare your chapter 1 or 5 to somebody else's chapter 30. Stop comparing yourself to others. Stop striving for perfection. Stop living a life based on the expectation of others. Also, you should stop living in the past. Right now, you need to throw away those regrets of the past. It's gone. There's no point dwelling on what could have been. Doing so is only going to rob you from the present moment of joy. Enjoy what's happening in your life at the moment, because the past doesn't exist other than a memory. It's a mental story. It can't be changed. I guess another point is accept there are some things that can't be changed. Just don't fight it. Another lesson I've learned over the years is practice mindful living. Mindful living is being aware of what's currently happening. Be there wherever you are. It slows down time. It enhances the present moment. It could fill an otherwise mundane day with awe, with joy. Now, while I do want you to become wealthy, and I do want you to have more financial freedom, and I do want you to have more choices in life, I also want you to be careful how you chase money, fame, possessions. Sure, we crave wealth, prestige, fame, popularity. We crave material things. We want to be beautiful. We mistakenly, though, think that when all this arrives, you're suddenly going to be happy. You're suddenly going to reach your goals. And that's not necessarily the case. So a lot of people I know currently are, instead of enjoying their life now, are constantly in pursuit of something other than where they are right now. They don't appreciate it. At the end of your life, your expensive BMW won't be what's flashing past in your mind. You're more likely to remember the memory of your loyal dog. So stop chasing material possessions. There's no real happiness there. It's only an ongoing endless pursuit on a treadmill, isn't it? In other words, practice gratitude. Be grateful for what you've got. If you're not grateful, you will never be wealthy. And I guess the last lesson I'd like to just share with you as I throw some ideas out at you to enjoy life more rather than just chasing money is pay attention to the sources of love in your life. And you're going to develop a growing sense of abundance and how much beauty surrounds you each day. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?